Meeting to order, dealing with the Budget Implementation Act C-44, and we have today with us a number of officials from the Finance Canada. The way I'd suggest we proceed, sometimes we just deal with each part and then go to questions, and I think we're okay with committee members. We'll have the presentations on part 1, then the presentations on part 2, then the presentations on part 3, and then we'll go to questionings of all the witnesses. Are people okay with that? So, then starting with the part 1, we have Mr. McGowan, Mr. LeBlanc, and Mr. Green. I don't know if you want to, in your opening statements, mention what areas of responsibility you are, because I don't have that in my documents. Yes, I do. I'll give your title, Trevor. Mr. McGowan is the Senior Legislative Chief, Tax Legislation Division, Tax Policy Branch. Mr. LeBlanc is Director, Personal Income Tax Division, Tax Policy Branch. And Mr. Green is Senior Advisor, Tax Policy Branch. Welcome, and the floor is yours on Part 1, amendments to the Income Tax Act and to related legislation.
Thank you. As you said, I'll be providing the introductory remarks relating to Part 1, which relate to the income tax amendments. My colleagues Pierre and Gervais will discuss respectively Parts 2 and Parts 3. Providing a brief overview of the measures. The first is some measures relating to veterans and veteran benefits. They would ensure the non-taxability of the new Canada Caregiver Recognition Benefit, which replaces the previously non-taxable Family Caregiver Relief Benefit. What these amendments do is ensure that the new benefit has the same tax-exempt character as the previous one. These substantive amendments are contained in the bill in Division 12 of Part 4. And these are in the bill in clauses 2, 6, and 29. It also, as a result of the tax expenditure review, eliminates the investment tax credit for childcare spaces. This is a 25% non-refundable tax credit for employers with a maximum of up to $10,000 per eligible child care space created. And this would be eliminated in respect of expenditures incurred after March 21st, 2017. However, there is transitional relief provided so that expenditures incurred under an agreement that was entered into before Budget Day would have until 2020 to complete the work and obtain the credit. That can be found in clauses 3, 4, and 23 of the bill. Next is the elimination of the deduction for eligible home relocation loans. Again, this is a part of the tax expenditure review. When an employee obtains a loan at below market interest rates, the difference between the market rate and what they pay is a taxable benefit. This deduction offset that benefit for qualifying employees on up to a notional $25,000 loan. The next is the elimination of the tax exemption for non-accountable allowances for members of legislative assemblies and certain municipal officers. That, to reiterate, eliminates the non-accountable reimbursements of the tax exemption for those. Of course, as with every employee, reimbursements that are accounted for would remain tax exempt. So if you have a taxi ride from an airport to a hotel for a business trip, you submit that, you get a reimbursement for it. That would, of course, be non-taxable. It's the non-accountable allowances that the non-taxability is being eliminated for. Next is, again, as part of the tax expenditure review, the elimination of the tax exemption for insurers of farming and fishing property. This was a tax exemption that is based on the premium income that qualifying insurance companies earn from insuring farming and fishing properties. That would be eliminated for taxation years that begin after 2018, so starting in 2019. That is clauses 7, 24, and 33 of the bill. Next would be the elimination, again as part of the tax expenditure review, of the additional deduction available for corporations in respect of gifts of eligible medicines to a qualifying donee charity. This deduction is available in addition to the existing charitable tax credit or charitable deduction that's available in respect of gifts of medicine, which would apply to the fair market value of the medicine donated. That is in clauses 9, 25, and 32 of the bill. Next is a simplification measure. Again, in the context of the tax expenditure review, it replaces the existing caregiver credit, infirm dependent credit, and family caregiver tax credit with a new Canada caregiver credit. It's available for the 2017 and subsequent taxation years, and it can be found in clauses 11, 12, and 14 of the bill. Next, as part of the tax expenditure review, is the elimination of the transit pass tax credit. It would eliminate, in respect of transit use after June 2017, so starting July 1, 2017, the tax credit for public transit use. That is in clauses 13 and 23 of the bill. Next is an amendment to the medical expense tax credit. It ensures that certain costs relating to the use of reproductive technologies in order to conceive a child are eligible for the medical expense tax credit, even though the underlying cause for the treatment is not related to an underlying medical condition. An example of that would be for same-sex couples needing this treatment to conceive a child. That can be found in clause 15 of the bill. The next amendment relates to the disability tax credit. In order to qualify for the disability tax credit, a disability must be certified by a qualifying professional, so for instance doctors or certain enumerated specialists. This would extend the list of medical practitioners that can certify eligibility for the tax credit to include nurse practitioners, who for many Canadians are a significant point of contact in the healthcare system. That can be found in clauses 16 and 17 of the bill. Next, we have amendments to the tuition tax credit. These fill a gap in the currently existing tuition tax credit rules as they relate to fees paid for skills training courses. Currently, post-secondary courses taken out of post-secondary education are eligible for the tax credit. Job skills courses taken out of qualifying educational institution, second language skills, things like that. Those are also eligible for the tuition tax credit, but if you take one of those job skills courses at a post-secondary educational institution, like a university, there was a gap in the rules and you couldn't get a credit, even though one would expect it to be available, and this amendment would fill that hole for the 2017 and subsequent taxation year. This can be found in clauses 18 and 19 of the bill. The next measure would extend for 1 year the mineral exploration tax credit in respect of certain grassroots mineral exploration. And this extends the credit to be available in respect of so-called flow-through share agreements entered into on or before March 31st, 2018, and this would support exploration for these qualifying minerals to the end of 2019. That is in clause 23 of the bill. Next is the elimination of the tobacco manufacturer's surtax. This amendment to the Income Tax Act would eliminate the surtax, which applies to Canadian producers, and it's made in conjunction with amendments to the excise duty rates in Part 3 of the bill, which are intended to maintain the intended tax burden on tobacco products. Next are amendments allowing for the permitting employers to distribute T4 slips to their employees without first having to obtain consent from the employees, so that sets a new default for the distribution of T4s, subject to some important safeguards. First of all, appropriate privacy safeguards have to be in place. Second, it must be reasonable to expect that the employee would be able to have access to these T4 slips. And third, if the employee says they want paper slips, they have to get paper slips. Lastly, and that is in clauses 28 and 31 of the bill. Lastly is an extension for 1 year of the repeal of the National Child Benefit Supplement that is found in the calculation of the Canada Child Benefit, even though it does not affect the calculation of the Canada Child Benefit. A number of provincial programs refer to the former National Child Benefit Supplement for their calculation, and specifically to the variable in the Canada Child Benefit that contains the NCBS. And so it was left in and scheduled to be repealed effective July 1st, 2017. This repeal is being moved back to July 1, 2018 to give provinces additional time to update their rules. And that's the end of Part 1.
Mr. LeBlanc or Mr. Green have anything else to add on Part 1? Okay, then if we could go to Part 2, Mr. Marcel.
Oui.
Do you want to give us what your position is, Pierre, please?
OK. Bonjour, mon nom est Pierre Mercier. Je suis chef législatif.
Good afternoon. I'm the Chief Legislative Officer at the Sale Tax Division of the Department of Finance. Part 2 of the bill implements measures on the goods and services tax and the harmonised sales tax. There are 3 measures in GST-HST.
Restores the GST-HST free treatment of the drug naloxone when it is supplied without a prescription for emergency use to treat opioid overdose outside hospital settings. This amendment generally comes into effect on March 22nd, 2016. The second measure amends the definition of taxi business. Under the GST-HST, all taxi operators or independent drivers are required to register for the GST-HST and charge tax on their fares, irrespective of the level of their sales. These rules have been put in place since the inception of the GST and ensure that all taxi operators are treated the same way. Commercial ride-sharing services facilitated by web application provide passenger transportation service that are similar to taxi services. However, such ride-sharing services may not be subject to the same GST-HST rules as taxi business because they may not fall under the current definition of taxi business. So to ensure that the GST-HST apply consistently to taxi services and ride-sharing services, the definition taxi business in the GST-HST legislation is amended to require the providers of the ride-sharing services, we're talking here about the independent drivers, to register for the GST-HST and charge tax on their fare in the same manner as taxi operators. The amendment will be effective as of July 1st, 2017. The last measure in Part 2 of the bill repeals the GST-HST rebate available to non-resident individuals and tour operators for the GST-HST that is payable in respect of the accommodation portion, the Canadian accommodation portion of eligible tour packages. This rebate is complex, it's costly to administer, and it benefits only a narrow segment of the tourism industry. Therefore, it was considered an inefficient tax measure. The repeal will generally apply in respect of supply of tour packages or accommodation made after March 22nd, 2017, which is the date of the budget. There is also a transitional measure in respect of which the rebate will continue to be available in respect of supply of tour packages and accommodation made after March 22nd, 2017, but before January 1st, 2018, if all of the consideration for the supply of the tour package is paid before January 1st, 2018. Ceci conclut la description des mesures dans la partie.
That concludes the description of measures in Part 2 of the bill.
Part 3, amendments to the Excise Tax 2001 and the Economic Action Plan 2014 Act Number 1. Mr. Kaloum, who is the Chief Sales Tax Division Tax Policy Branch. Welcome, sir. The floor is yours.
Merci, Monsieur le Président. So I'm here today to discuss the two proposed excise measures that were included in Budget 2017 regarding tobacco and alcohol taxation and that are included in Part 3 of the bill in front of you. La première mesure traite de la taxation du...
The first measure is on the taxation of tobacco. It is in Articles 45 to 48, 51, 54, 58 to 63.
Tobacco manufacturer surtax. The first excise measure proposed to adjust the rate of tobacco excise duty to ensure that the peak level of revenues collected under the surtax in the early 2000s will be collected under the excise duty framework. For example, the excise duty rate on cigarettes will increase by 53 cents per carton of 200 cigarettes, rising from about $21.03 per carton to $21.56 per carton. To ensure that the increase is applied in a consistent manner to all cigarettes at different trade levels, an equivalent inventory tax will also apply to inventories of more than 30,000 cigarettes held by manufacturers, importers, wholesalers, and retailers as of the end of budget day. Toutes ces mesures s'appliquent généralement à compter du 23 mars.
All measures will apply generally as of March 23, 2017. The changes proposed to taxation on tobacco should generate some $55 million of additional revenue for 2017-18. The second measure that I'm responsible for, which is under study here today, is alcohol taxation and federal excise measures. It is found in Articles 42 to 44, 53, 55 to 57, and 64 to 65.
Increase the excise duty rates on alcohol products by 2% and to automatically adjust these rates to account for inflation on April 1st of every year, starting in 2018. The government generally applies an excise duty on alcohol products such as beer, wine, and spirits that enter into the Canadian duty-paid market. Alcohol excise duty rates were effectively last adjusted in the mid-80s, so therefore their effectiveness, real value, has eroded over time. In 2017, the proposed measure represents an increase in excise duty of 5 cents per case of 24 bottles of beer, less than 1 cent per bottle of wine, and about 7 cents for a typical bottle of spirits. The proposal is expected to generate about $30 million in additional revenue in 2017-18. Cette mesure s'applique également généralement à compter du 23.
This measure generally comes into effect on March 23, 2017, the day after the budget. That completes my overview of Part 3. Thank you.
Go to questions, and normally in this process we don't go to the normal rounds. We can go back and forth. If you feel a question comes up after you heard another answer, we're welcome to go back to you. We're not under any specific time frames on this session. So first we had Mr. Graywall, then Mr. Liepert, and then Mr. Deltel, or we'll go to Mr. Desault and then Mr. Deltel. Okay, Mr. Graywall.
Thank you, Mr. Chair, and thank you to department officials for coming today. I really was really happy with the government's decision to change the definition of taxi driver. I'm the proud son of a taxi driver. A lot of my family was in the taxi business. So as you know, as the industry has been changing with ride-sharing companies such as Uber, they've been put in a very difficult position because they know their business model and they work very hard at it. But then, you know, obviously we have an innovative economy and this new app comes out and it totally, you know, changes the way the traditional taxi model. One of the biggest complaints that they had was that, you know, we work hard and we pay our taxes. And Uber's got this advantage when they're not charged HST. So we've changed the definition. I just wanted to ask you guys, how is this going to work in practicality? Will Uber be collecting the HST, GST portion through their app, or will each individual driver be collecting it and remitting it to the government?
I'm not sure at this point we have this information. What we understand is that the business model of those providers of ride sharing is that there's be no exchange of money between the driver and the application that facilitate the matching of the driver with the passenger. So the rule here doesn't force a particular system to be put in place. If Uber decide to collect the money, they will remit the money to the taxi driver. If they collect the tax, they would remit it to the taxi driver, and the taxi driver will have to remit the tax themselves. If the web operator doesn't collect it, then the taxi driver will have to do it himself.
So in practicality, it would probably be the web operator that has to collect it because the payment form on ride sharing is seamless, right? So like you register your credit card, you open up the app, you click I'm going here, our car shows up. There's never any exchange of funds between you and the driver. So I wouldn't see in what scenario the driver would be able to collect it because everything is operated centrally.
Yeah, but I cannot answer on the name of those companies. So
Okay.
they're not, these are often companies that are not located in Canada, so it's very difficult to force a business model on them. So, but I guess they will let their drivers know how the system, what they intend to do.
Okay, so you mentioned that a lot of these companies aren't based in Canada, but because they operate business in Canada, they are obligated to pay Canadian taxes, such as HST and.
Well, they're actually not located in Canada, and they argue they're not making any supplies in Canada.
Well, what they argue and what the reality is two different things, right? So I'm saying is that we've changed the definition of taxi business here, and now as a member of the Department of Finance, the simple question is this, is that after July 1st, I would expect all Canadians who drive for Uber to be collecting HST.
The drivers of, you can mention Uber, but there's many more companies. There's Lyft, Phase Drive, all sorts of new companies are coming on the market.
That's fine.
And some may be located in Canada, some are not located in Canada. Those who are not located in Canada, normally the way the system works is that if a driver receives a service from a foreign company of that nature, which is an intangible services, they would have to self-assess the tax and claim input tax credit if they're allowed to do it. By being registered, the taxi business would receive a service from the foreign company of providing a match from the driver and the passenger. And this amendment doesn't force a foreign company to collect tax. It's because it's legally very difficult to force a foreign company to collect tax.
So,
because you have no enforcement mechanism on them, they're not located in Canada.
Practically speaking then, let's talk about this hypothetical situation. Is that July 1st comes and Uber, the headquarters company, decides not to implement HST on its fares. Are you saying that the interpretation of this provision puts that onus on the individual driver to collect it?
They will have to collect from the passenger if Uber or other company have not collected for them.
And if the driver does not have the ability to change the fare on the app, is the driver supposed to say, well, pull out your 14 cents on my calendar, I'm sorry, my calculator here, and give that to me in cash? Is that the interpretation of this law?
The fare that is put on the app by Uber is called, in terms of legislation, it's the consideration for the supply. It's the price. The tax always apply in addition to the consideration for the supply.
I understand that, yes.
So if only from the passenger the consideration have been collected, the driver will have to collect the tax. But in practice, I suspect that is highly probable that the app operator will collect, because they will not want to have exchange of money between the driver and the passenger, and because some client may not do business with them if they have to do that, if they cannot have the simplified payment model.
Yeah,
but this is a decision for the app operator to make.
Yeah, and you're saying before that, your previous statement was that the app operator may not be a business located in Canada, so they may decide to just totally ignore the government's position on this?
Well, the amendment here applies to the, basically it's a law in Canada that applies to people in Canada, and in this case it applies mainly to the drivers, and like I say, like those app operators located in Netherlands or Barbados and places like that, you know, it's very difficult to enforce any tax on them, but the market pressure may be enough to obtain the result that you want.
Well, I guess we'll both wait and see eagerly.
Yeah.
Thank you so much. That was really interesting. I didn't know that's how it was being interpreted. Okay. So I really appreciate that. How much time do I have left, Chairman?
To you, is that it for the taxi questions? We'll come back to you in another round. I'm just wondering, Mr. Marcel, has discussions already begun with these companies as yet on the implementation of this the HST, like with Uber and others?
I understand that there have been discussion, but I don't think that
I'm not asking
the company have expressed the way they're going to do business. I was not present in any discussion.
Okay, thank you, Mr. Leipert, and I assume you want on the list again, Raj. Mr. Graywell, Mr. Leipert.
Thank you. I want to preface my question with a little history lesson. I come from Alberta, and I know we've got a few of our friends across the aisle here who weren't in elected office at the time we had a thriving Canadian economy based on a strong oil and gas sector. And all of the country benefited. We had a huge trade surplus. Manufacturers in central Canada were doing record business in the oil patch. And then, of course, as we all know, we had the world price of oil collapse. Now, as prices have started to come back, and during that collapse, we had probably 3/4 to maybe even 80 to 90% of the rigs idle because nobody was spending any money. So now that the prices started to climb back up, companies have started to engage drilling companies to go out and explore for conventional oil. And in this particular budget, the government has slapped the oil industry by proposing to reduce the petroleum drilling incentive. What justification would that have by finance officials, or is it purely political?
Green?
Thank you, Mr. Chairman. Just to understand, the measure that the honourable member is referring to is not contained in this bill. So, I just appreciate your views on whether or not that should be
The
topic for
drilling incentive, I heard Mr. McGowan mention that earlier. The reduced drilling incentive, tax credit.
I did mention the one-year extension for the exploration tax credit relating to grassroots mining expenditures.
Okay, so that the reduction, the decision to do away with a good chunk of the drilling incentive is not in this?
The amendments relating to oil and gas, and certain expenses as exploration expenses or development expenses announced as part of the budget are not in this bill.
Well, where are they?
They were. It's common for the tax amendments announced as part of a budget process to be split into two tranches. One to be introduced in a spring bill, the first Budget Implementation Act. Others that, well, for one reason or another, for example, legislative complexity, desire to hear more stakeholder input, and the necessity of timing of when they come in or not, can often be deferred to be included in a summer release, perhaps with revisions based on stakeholder feedback, and then included in the second Budget Implementation Act to be tabled in the fall. And the measures I believe you're referring to were not included in this, and so they could be tabled in the fall second Budget Implementation Act for 2017.
Then on this, Mr. Leipert, that question is probably more appropriate for the minister because it was said in the budget statement, correct? But it isn't in this particular Budget Implementation Act.
That's correct, Mr. Chairman.
Okay, so I think as far as your question, Mr. Leipert, then when the minister is before us, because it is relating to something he said, it can be directed then. But that section is not in this particular Bill C-44.
Well, okay, if I could just ask, is there any reason why, specific to this? You mentioned it's not untypical, and you gave some generalities why this happens. Anything specific as to why it's not in this particular bill? Is there going to be some kind of consultation with industry or what?
I unfortunately can't. The decision on which measures are included in the first bill versus the second bill, of course, is a measure taken by the Minister of Finance or above us at the political level. And unfortunately, I don't believe that I can provide our advice as to why one thing or another ought to be put in one bill or another, nor can I speak for the minister as to why one way was decided rather than the other. I did provide the three general types of considerations, namely the necessity of something being enacted by a particular date, the relative legislative complexity, and the desire to receive receive feedback and engage with stakeholders on the
okay,
proposal.
Mr. Chairman, I'll leave it at that, but it's no wonder Canadians can't understand how government works when the minister says something in the budget address and then it sort of disappears.
As I understand it, because we've had this discussion on what's it called, bill-based accounting as well, as I understand it, it's stated in the budget, I think along the lines that Mr. McGowan suggested, to give a heads up, to give notice that this is being considered and for consultations and feedback. That's how I understand it. And things may or may not change over the summer. Mr. Green, you wanted to add something?
Yes, Mr. Chairman, just to add to my colleague's remarks, without making any guarantees about how things will proceed this year, it has been the practice in recent years that tax measures contained in the second Budget Implementation Act, as Mr. McGowan alluded to, are released by the government in draft form, particularly given the complexity that's involved in these types of measures, to give affected parties, stakeholders, industries, and so on, the opportunity to comment on the proposed legislation before it is introduced in Parliament. Thanks.
That's all I have for now. Thank you.
Come back later in any event if needed. Mr. Dussault.
Merci, merci à vous pour.
Thank you very much for being here with us today. I have a number of questions. Of course, these are not bills that are as omnibus style as under the Conservatives, not as large or voluminous, and they would bring in a couple of such a year. But let me get back to, and I might get back to that in a second round, but right now, first, the fishing and agricultural businesses, insurers. Correct me if I'm wrong, but these insurance companies have a fiscal advantage, a tax advantage compared to other companies. Those who are serving almost exclusively companies in fishing and agriculture. Am I mistaken?
The measure in question was a tax exemption that applies to insurers that insure farming or fishing property, and they have to have at least 20% of their premium income from those policy segments.
Et là, le projet de loi vise à éliminer cet avantage fiscal.
The bill would withdraw this fiscal credit, this advantage provided to these insurers, correct?
Et est-ce que vous pouvez élaborer sur la raison pour laquelle cette...
Could you remind me why we are withdrawing this advantage for these particular insurers who say that this is advantageous for them, the current measure, allowing them to insure farmers and fishers who are sometimes in far-flung areas and otherwise don't have insurance?
They'll locate you. Go ahead.
Thank you, Mr. Chairman. This tax exemption, which is a somewhat unusual measure in the sense that it's an exemption for insurance companies who provide a particular line of insurance. It was introduced in 1954 in an effort to encourage the provision of insurance in what was seen to be an underserviced market, that for farming and fishing property and businesses. And as part of the government examined this measure as part of its review of tax expenditures, and came to the view that it was difficult to say that this measure is effective and appropriate in today's economy, which has changed very significantly over the past 60 years. A provision that provides that insurance companies don't have to pay tax on a particular line of business is an unusual provision in today's economy. Certainly, the view is that the insurance market is now well developed and mature, and with the sophistication of the Canadian financial sector, that a broad range of companies, both share companies and mutual companies, are well placed to effectively write policies in the farm and fishing business. And the provision was seen to raise fairness issues with respect to other sectors. So the budget proposes to eliminate the measure.
Est-ce qu'on sait à peu près combien de compagnies d'assurance ça peut affecter?
We know how many insurance companies about will be affected by this, and those who currently take advantage of this exemption, and after this bill is enacted, will no longer be able to take advantage of it.
In the past 5 years, the exemption has benefited on average about 40 insurance companies each year.
Et si je ne me trompe pas, on parle, je pense que c'est vos chiffres.
Those are your figures. If I'm not mistaken, this will generate revenues. Well, actually, it will, yes, generate 10 million in revenue, correct?
it's estimated to raise about $10 million per year.
Monsieur le Président,
Mr. Chair, that was my only question regarding, well, the figure or letter E, and I can certainly come back with other questions later.
Then we'll turn to Mr. Ouellette and Mr. Dussault.
Merci beaucoup. Tapoué.
Thank you very much. It's very kind of you to appear before us so we can discuss the budget in greater detail. Let me look at, in Part 1, Clause 23, addressing credit, tax credits for childcare spaces. If I look at the old scheme, it was 25% up to $10,000, meaning each space for each child could cost $40,000 in the old scheme, unless I'm mistaken. Is that right?
That's correct. It was a 25% tax credit. The maximum credit per space is $10,000. So in other words, $40,000 was the maximum amount of eligible expenses.
Hey, c'est cher pour chaque enfant. Wow, c'est même...
Certainly expensive per child.
Covers, capital costs, so the cost of the building and furniture, equipment, materials, as well as...
oui, sûrement, c'est extrêmement cher, oui.
Yes, I imagine so. That must account for the cost, it being so expensive. Now, we have announced other investments. Can you tell us a bit more about those?
Investments in childcare spaces in our proposals?
Mr. Chairman, I guess I could just say that the budget does propose significant new investment. The budget announced that an additional $7 billion will be invested over 10 years, starting in 2018-19, to support and create more quality, affordable childcare spaces across the country. The aim will be to increase the number of spaces for low and modest income families by supporting up to 40,000 new subsidized childcare spaces and to help make it more affordable for parents to return to work. And this builds on the initial $500 million that was announced in budget 2016.
C'est excellent. Merci beaucoup. La prochaine chose que je voulais parler...
Thank you very much. Now, the next topic I would like to address is in Section 9, 110 of the Income Tax Act, elimination of the additional deductions for gifts of medicine. Now, what is the government going to save by doing this? I know that there are stock options, measures. People can make a gift that way and benefit from it. But medicine, is there any way we could apply this measure that, would be costly? Is there another way of going about this? Any way we could ensure that pharmaceutical companies are induced to make gifts to help protect the health of others around the world?
I would just note that the budget, as the honourable member has indicated, proposes to eliminate an additional deduction for gifts of medicines made by companies out of their inventory of medicine. It's important to note that companies will continue to have access to the general charitable deduction that's available to all companies that make charitable gifts. So it's only this additional incentive that was specifically targeted at gifts of medicines that is proposed to be eliminated. And again, the basic rationale for this proposal is that the measure has not been very effective in its intended purpose. between 2011 and 2015, an annual average of around 10 corporations have claimed this additional deduction, and the average annual cost has been less than $250,000, which, you know, when you consider the size of the companies involved in the pharmaceutical industry is not really even a material amount.
I guess the pharmaceutical companies weren't very generous.
Well, I can't say.
Hopefully in the future, maybe after hearing this, they will be.
Yeah, I mean, this data only applies to the additional deduction. It's possible the companies may have been making the donations and not claiming.
I only have a few more minutes left, maybe a minute and a half. I was just wondering about if we could talk about the elimination of the tobacco manufacturer surtax. Alors, je veux savoir, est-ce que ça va faire en sorte que les cigarettes deviennent moins chères?
Will this lead to cigarettes costing less? The measure is aimed to claw back the amounts that we were getting with the surtax at the beginning of this century, but now and today there are companies that were always paying the surtax, even recently, because they were doing business here in Canada. These companies, if they stop paying the surtax, but the excise duties are higher, we might indeed be selling their products for about the same price, at least in the current market conditions. This said, some importers of tobacco products, of cigarettes, that weren't paying the surtax, given that they were producing their products outside of Canada, well, their products just might cost more. Then how this is passed on to the final user, well, each company would, of course, organize that for themselves. As I say then, it's really a 53-cent higher excise tax that's per cigarette that's at issue. Thank you. And the T4 information slips, the T4s. I'd just like to speak about them for a moment. Of course, we know that people certainly like using electronic methods of information sharing, but sometimes employers, even in the Army, have taken for granted that people have computers. I mean, I had an employer who took that for granted, and I actually didn't have access to a computer, nor did I have access to an order room or an administration office to be able to work on these issues. So sometimes this can be a good idea, but I always prefer paper because it's something that I can actually see and hold in my hands. And it certainly reminds me that I have to get going and work up my income tax statement. So keep in mind that this might not be helping people who tend to more easily forget to even delve into preparing their income tax statement. It's just a comment. You know, these are the sort of things one has to think over quite carefully.
I guess the good news on that front is that any employee who wants a paper copy has a right to get a paper copy. After they've requested, the employer has to provide it in paper format. In addition, there are protections built into the rules so that if an employer cannot reasonably expect that their employees have access to them, two specific examples were included in the bill. One, if they're on extended leave, or two, if they're former employees, but also if you just generally can't reasonably expect that they'd have access to a computer, then you can't provide it electronically. It has to be in paper format. So there are these protections built into it to ensure that people don't miss out on their T4s.
Mr. Roulette, Mr. Deltel, and then Ms. O'Connell.
Thank you so much, Mr. Chair. Gentlemen, be welcome to your House of Commons. Et c'est avec une évidente fierté comme Québécois que je constate que parmi...
Great pride as a Quebecer that I see here that of the 6 people representing the Minister of Finance here, 4 are Francophone. So this is something I'm very happy about. Even General de Gaulle would be congratulating us. Now, I will address the issue of the excise tax on alcohol and tobacco products. So first on alcoholic products, according to the federal budget 2017, the increase proposed would raise the federal government income by $20 million the first year, $60 the second, $80, $150, and higher in the following years. So all this is very technical. I would like Mr. Coulombe to explain to us how we can get such an exponential raise in tax here at the federal government. Thank you for your question. In the first year, 2017 and 18, the $30 million greater tax intake is linked to the 2% rise in excise tax. For future years, in order to respect inflation, the plan is to raise it on the 1st of April of each following year, such that should inflation be 2% next year, the adjustment on the 1st of April 2018 would be a 2% raise. Thus, the measure would lead to higher revenues in that year and in future years. But if we compare that to what we're now raising at the federal level, public accounts for the year ending 23rd of March last, the government raised about $1.6 billion in excise tax. Well, that's the point, Mr. Chair. This is the issue, and I thank our official here for these clear explanations. This is what Jacques Parizeau, the former now regretted Jacques Parizeau, said, well, this is kind of like a ladder tax. It's going up, but it never comes down in this case. So this costs more for our clients, of course, for taxpayers, and also for those whom they hire in restaurants, in places that alcohol is sold. And this is why, Mr. Chair, the Association of Alcohol Product Producers was really unhappy with this. I quote,
to sell Canadian spirit manufacturer with higher taxes at this time. Et un peu plus tard dans leur communiqué, ils expliquent, et je cite encore, parce que là, c'est là qu'on va...
A little further on in their statement, they say, and this gets right to the heart of the matter,
Federal excise duty to CPI is a return to the failed policies of the past. Between 1981 and 1986, annual automatic adjustment to alcohol excise duty result in massive job losses and plant closure across the country, unquote. Alors, ma question, Monsieur le Président, et je comprends que nous sommes...
So my question, Mr. Chair, and of course we are not undertaking a partisan debate here, so I'm looking for a technical response only. Has the Minister of Finance calculated the impact this would have on companies that produce alcohol, that sell alcohol? Well, as we were working out projected income for future years, given the very slight increase being planned for, we didn't take into account a potential drop in consumption of alcohol products across Canada. So my question is not so much about less alcohol products being consumed and more on the potential impact on producers and those who sell alcoholic products in places they're sold, restaurants and bars, for example. There are a number of elements to consider, a number of aspects to your question. Now, you know, excise duties on import alcohol products apply to their full value. What I mean by that is that a bottle of wine imported from France will be slapped with an excise duty tax. Let's say it's a 750 milliliter bottle, and the excise tax would be about 46 cents on that. The very same product, made in Canada, produced here from solely Canadian agricultural products, is not charged any excise tax. So a great number of the products at issue here are already exempted of tax.
if I look at beer, one of the products on which there will be excise tax, there will be reduced fees for small producers. Without going into detail, depending on the number of liters and deciliters and hectoliters that they produce, small producers will be paying much lower taxes. They may be increased in the future, but the exemption, the structure of those reduced taxes will be maintained in accordance with the proposal put forward by the government. Another aspect of your question related to retail sales. As you know, in Canada, in all provinces except Alberta, there is a monopoly. Liquor boards sell most of alcohol containing products and therefore have a great role to play in establishing final prices. Therefore, the impact of this measure will depend on how they make their readjustments. Mr. Chairman, I do appreciate the caliber of our guests' answer because we're really going into great detail. But this is worrying for producers. Their profit margin has dropped over the years. It used to be about 8.4%, but now it's about 4.3%. Competitiveness and competition does play a role, but the taxes and progressive taxes are playing a significant role. That is why the Restaurants Association said,
and result in sales decline and job losses. And our future is at risk as our ability to create jobs and pure economic growth are concerned, unquote. Et c'est pour ça, Monsieur le Président, que lorsque l'on crée...
That's why, Mr. Chairman, when you create a progressive tax, it has a direct impact not only on the front lines, but on the industry as a whole. Again, the Vintners Association said,
our plants and brands force us scaling back to innovation, depress sales, reduce our grains purchase from Canadian farms, and lower our new export market development, unquote. Donc, Monsieur le Président...
So, Mr. Chairman, and I want to thank those who are here to give us such detailed explanations. But in reality, that elevator tax, which was created and is being imposed by the Liberal government, is going to have a negative effect on the Canadian economy.
Mr. Colombe.
Merci. Un tout petit détail technique.
Thank you. One technical detail. Mr. Deltel, you mentioned a comparison with a mechanism used for excise taxes that were in place in the early 80s. I'd like to add some detail. The automatic inflation mechanism that is being established by the government is based on the CPI, which is a general index, whereas in the early 80s it was based on the prices of alcohol-containing products only, and it had a very spiraling elevator effect. That's not here. That's not what's happening here. By using the CPI, as was suggested for this bill for tobacco products, that's avoided, and we see that it's also useful in maintaining a minimum threshold. The specific nature of using fixed excise taxes as expressed in dollars per litre, if that's not adjusted to take account of inflation over time, there is a real drop in the value of those taxes. And that's what can happen in the provinces with the liquor boards. Their markup, their profit margin is expressed as a percentage. Thank you.
Well, I do have a couple of questions on this area as well. You said the real drop, there is a real drop in the value of these taxes. But that's the minister's decision in any budget. If there is a real drop based on what departmental officials are coming forward with to the minister with, the minister can, is it not correct, impose or bring in a budget with the a stated value on excises taxes to cover that? We don't need the inflationary adjustment in order to accommodate that drop in value. The minister can make that decision at any time he so decides in a budget, can he not?
You're right in the sense that these are all political decisions, as the minister has the ability to propose to Parliament an automatic mechanism that makes those adjustments appearing in the future. These are ultimately all political decisions.
Yeah, I kind of come from the step from maybe a time when I think the ministers need to make these decisions and accept responsibility off them at the time. The other question I have is we know provinces in Canada certainly put this adjustment factor or inflation factor in the escalator. Can you name us some countries in the world that do this? That in terms of their tax regime have escalator clauses in for wine and beer and alcohol as a regular standard procedure rather than the minister making the decision annually or whatever? Is there any other countries do this?
C'est une information que je voudrais revérifier.
That's something I would like to check. What I could say, however, is that there's no jurisdiction where we see federal taxes with distribution monopolies in the provinces. This is very particular to Canada, so I would be very careful before making any generalizations, be it about the federal excise tax in relation to tax regulations in single states. For example, in the US and in many European countries, there are no automatic rules of this kind. Is that a good thing? Well, these are policy decisions. For tobacco, organizations, international organizations have in recent years recommended the implementation of mechanisms whereby scales would be periodically reviewed, excise tax scales. And those decisions can be taken by law or through less formal means, but that's a decision that's above my pay grade.
Another point that I would raise on the escalator is has there been any kind of analysis done by anyone on the implications on the Canadian grape industry, on maybe potential trade remedy actions that we might face when we handle imports differently than 100% Canadian wines? Has there been any analysis done in that area in terms of the escalator specifically?
To my knowledge, there has been no specific analysis done because of the presence of the escalator. Specifically, all the analysis was done as part of the overall proposed measure, and as mentioned earlier in my presentation, a 2% increase that effectively resulted in about 0.75 of additional excise duty on a bottle of wine has not been deemed for being potentially reducing any types of consumption of production patterns in Canada. And in respect of the grape industry, for instance, well, Canadian wine produced from 100% Canadian grapes continues to be fully capable of claiming the exemption, and there is no federal excise duty currently charged on these.
Okay.
On these type of wine. Thank you.
That's and that's why I raised the question of trade remedies. I do think you need to look at that. Ms. O'Connell.
Chair, some of my questions have actually already been asked, but I'm going to start by following up where you left off. In terms of the excise tax on alcohol and simply just the escalator, you mentioned that for example, for foreign imports, our 46 cents approximately would be charged for a 750 milliliter bottle. But my question is in regards to, this is an escalator that will be on in argument forever. So on the imports, is that also escalated? Because if not, there will come a day when we would be paying a higher tax on alcohol here than foreign imports. If there's an escalator only on one and not the other, at some point it would catch up.
The proposed excise duty rates apply equally to imports and domestic products subject to taxation. For instance, you do have some wine that is blended in Canada, and these types of wine blended from foreign and domestic products or grapes. These wines are also subject to the increased excise duty according to the proposed measure. So there is no discrepancies in respect of these products over time.
Okay, then I guess I'm confused about your earlier testimony about talking about 46 cents for foreign imports on, for example, a 750 milliliter bottle. If you're saying that the escalator, if there's a foreign blend, then they would be subject to this tax, then what were you talking about earlier with the 46 cents foreign import tax? Is that in addition to?
No.
Okay, could you clarify your testimony then?
So basically, how it works. You have an excise duty. This excise duty is imposed under the Excise Act 2001 in respect of wine produced and packaged in Canada. An equivalent duty is imposed under the customs tariff when the wine is imported at the border. This application of the duty applies only once. So you could have importation of bulk wine from Spain or from Australia that arrive here in big container, and because they are delivered to certain entities that further manufacture that product, the duty is kind of suspended and will be imposed only at the time of the bottle is being packaged and remitted. It is very, very technical. One may imagine you have hundreds of people administrating that at the Canada Revenue Agency and at the Canada Border Security Agency for us. So we're trying to explain it as we can. Thank you.
No, that makes sense. Thank you. I want to move on to the medical practitioners for persons with disabilities. I think this is a very good thing. And so if you could just, if someone could please, through the chair, explain in terms of how many people they think this will allow to be certified now, and what research or what rationale was done, and do we anticipate that there will be a higher uptake for persons with disabilities, for example, in more rural, remote communities? I know this is something that, for example, Atlantic Canada was specifically concerned about, so I'd like to hear the rationale and how many people you think will be able to now access these benefits.
Okay. Thank you for the question. I think what we can say is the policy objective is to make it easier for individuals with severe disabilities to be assessed for purposes of the disability tax credit. So, and as you mentioned, in many outlying rural regions, the nurse practitioner is often the first point of contact. Well, we don't have a specific estimate of what the uptick or the increase in disability tax credit eligibility will be. Our sense is that, we'll see how it plays out, our sense is that for a good number of individuals, might be applying now, but it's have to jump through more hoops, have to find a medical practitioner who's farther from them in order to get certified. So that in many cases, it'll make it easier for people to. So it's that reduction in time and possibly costs that'll be of benefit to Canadians with disabilities.
Thank you. In relation to the tuition tax credit, I just want to make sure I'm understanding this correctly. Essentially, previously, where tax credits would have been applicable for post-secondary institutions, but this is now somewhat expanding that to ensure that tuition fees for occupational skills courses are now eligible. Am I understanding that difference correctly?
That's right. So as Trevor explained, so right now a lot of the tuition tax credit is claimed for post-secondary courses as post-secondary institutions. You also have occupational skills courses. So Trevor gave the example of a second language course, say English as a second language. That's a good example, where it's by an institution certified by Employment and Social Development Canada. Now the thing is that we don't certify post-secondary education institutions. They're already they're mainly in the business of providing post-secondary education, but in some cases they also offer these other courses. Say it could be an English as a second language course to immigrants. So, and they don't go through the certification process. So it's kind of a little gap right now. They're not eligible for the credit. So we're adding them.
Okay, thank you for that clarification. And then I have two more questions, Mr. Chair. The other question is on the tobacco excise tax. Can you explain the cigarette inventory tax and then whatever the sorry, if I can pull it up. I wrote down, maybe if you can start by clarifying cigarette inventory tax and how the rationale is changing or how this will impact this tax essentially. I know my colleague asked about whether or not, this change will actually have the cost going down, but I don't know how that's the case. But I read in the report in terms of the cigarette inventory tax and some questions around that. Could you perhaps explain that difference? And then I'll find the part while you're doing that.
So the cigarette inventory tax is a technical additional measure to the main measure, that is to adjust the excise duty. We have had in the Excise Act 2001 that specific mechanism for many years now that is being used when the excise duty is being adjusted. For instance, the last time I think that was as part of budget 2014. How it works, basically, we ask that people having in their inventories more than 30,000 cigarettes, because the tax applies only on cigarettes, not on cigars, not on other manufactured tobacco. Basically, we ask them to file a return with the CRA. The rate of the tax is equivalent to the rate increase per carton of cigarettes. I don't have the technical details in front of me. It's 0.02 cents or something like that per cigarette. This is probably part of the budget documentation. Basically this measure is aimed at trying to equalize the treatment of people who would have had produced tobacco products the day before the increase kicks in, and people who are distributing those products after that date.
Right. So really, the rationale for this is to be able to tax those who have that massive amount of quantities and the distributors in a fair way, if that's what I'm understanding.
That's fair to say.
Okay, thank you. And in terms of the last round of question I have, thank you, Mr. Chair, is the public transit tax credit. We heard a lot about this in the House, but can somebody please explain the original rationale for the tax credit and whether or not it worked, and why the recommendation to then remove this credit?
Yeah. So thank you for the question. Mr. Chair, the credit was introduced in 2006. The goal of the credit was to increase public transit use, and through that use have a positive effect on greenhouse gas emissions and also on traffic congestion. There are a number of research studies that have shown that it hasn't had that effect, that the effect on public transit use has been very limited, and by extension, the effective cost of reducing greenhouse gas emissions extremely high. And that's the primary rationale for eliminating the credit.
Thank you. Sorry, Mr. Chair, if I can just ask a follow-up. You refer to some studies that back that up. Do you have anything that could be shared with the clerk to include to this committee that rationale?
Sure, we can follow up with that.
Thank you.
You can provide that, Mr. Zimmer. The floor is yours.
Yeah, thank you, Mr. Chair. It's good to see you again. I know we saw each other once in a while on AG, but it's good to be here. Just want to tie into my question, my colleague's question, Mr. Leipert's about carbon tax. And the way it relates to, we have a letter by a premier of a province in this country that was released today, and it relates to transfer payments being connected to carbon tax. And his letter references a document from the Finance Department, and it talks about one of the issues. It says this is from the Finance Department's document that was dated, and this is how it's relevant to the budget discussion today. It's current budget. It's the document's dated from your department October 14th, 2016, so I'd presume that discussion would be around the time of the budget discussion. One of the issues, this is on your document, one of the issues being looked at in the discussion ahead of the 2019 renewal of equalization program is the change to the treatment of carbon tax or carbon revenues within the program, of the transfer payment program. And the Premier of Saskatchewan is concerned that this is being tied together in some shape or form. And I guess I, along with many other Canadians, are concerned with carbon tax, period, let alone it being tied to the equalization program. I'll quote the letter from Premier Wall. I am writing to seek your assurance that there will be no linkage by the federal government between the provincial carbon tax policies and the federal transfer payments or any other type of federal payments to provinces such as infrastructure funding. Any such linkage would be a serious attack on federal-provincial relations in Canada. My question to you, has there been any discussion about this particular topic within the budget discussion of the current budget? Considering the time, has there been any discussion around the budget with this particular issue? Feel free, anyone can answer.
Gentlemen and the witnesses, has this got any relation to Bill C-44?
Mr. Chair, the reason why I bring it up is just the time and the date. October 14th is right around budget discussion. Certainly it's related. I guess I would just ask for your indulgence,
sure,
Mr. Chair.
If somebody...
I don't see the officials very often. If you wouldn't mind answering the question. The letter from the Premier of Saskatchewan is dated today, May 8th, 2017. So the letter just has come out today to ask this particular question from Finance. Are you able to answer that question?
I mean, if any of the officials want to answer it, that's their choice, or we can hand it over, Bob, to the Finance Minister when he comes. But the floor is yours, folks, if somebody wants to take it on.
Very briefly, first of all, this is not part of the bill that is before us for studied. And in addition to that, equalization, questions in respect of equalization formula and territorial financing formula are not usually dealt by myself and colleagues from the tax policy branch. So this is unfortunately beyond our area of expertise.
Okay. Okay. Well, thanks for trying. I have another question. Yeah, thanks for trying. It's worth a shot. I'm on Human Resource Committee and Vice Chair, and one thing that's come as part of our discussion, we hear it from Minister Duclos when he comes to speak to us, and also from Liberal members of our particular committee, is the discussion around a basic income guarantee. We just did a poverty reduction strategy, and there's been further talk about it, and maybe similarly to what Mr. Leipert has said, it's been talked about as part of the budget discussion. Has a basic income guarantee been costed by finance, and what would that cost Canadians to fully implement?
Yeah.
LeBlanc?
Yeah, we don't, as the Department of Finance, have a cost estimate for a basic income.
Just can you clarify? There's a test period that's going to happen in Ontario where the basic income guarantee is going to be rolled out in some test communities. Do you have a cost of that particular of the test communities?
No, we don't. With the announcement was pretty sparse on details, so it's unclear exactly who would qualify. So, and because of that, it's we're not in a position to provide a cost estimate. We don't know who will get it.
So just to clarify, the cost if a basic income guarantee program is implemented across Canada, that has not been costed to date by the department?
No, not to the best of my knowledge, not by our department.
Yes.
Okay, thanks, Mr. Chair.
Okay, Mr. Sabara, and then Mr. Dussault, and then we'll take a 5-minute break. Mr. Sabara.
Thank you, Mr. Chair. Welcome, everyone. Great to see everybody again. Couple of questions on the Canada Caregiver Credit and the consolidation of the 3 tax credits into one. What is the estimated fiscal impact from that consolidation?
Although, sorry to try to do that. Thank you for your question, Mr. Chair. We estimate that the consolidation of these measures into the Canada Caregiver Credit will have a net reduction of federal taxes by about $310 million. $310 million over the fiscal planning period. That is from 2016-17 through 21-22.
So approximately what, $50 million a year, if my math is right, or something?
Yeah, it's
a little bit more than that, actually.
The first full year will be 50, and then it'll be $65 million a year by the end of the in 21-22.
So effectively, a tax reduction to a number of families in Canada that really, really need it. If I can use those political words, you can use finance words if you wish.
Yeah, I mean, I think what I'll add there, it is a net tax reduction, and one of the main groups that'll benefit right now with 3 different caregiver credits, probably, and these are phased out depending on the dependent's net income. The group where it's phased out more quickly is if I'm looking for an infirm family member who doesn't live with me, let's say a grandmother living down the street or across town. So in that, it's going to be one income level where it's phased out, and for that group in particular, since it'll be phased out at a higher income level, more can benefit.
Okay. Second question on the in relation to the tuition tax credit and student eligibility. Any estimates on what the uptake will be, or the broadening of the base with the changes to that tax credit?
Yeah, we don't think it'll be very large, so we don't have a specific number in our costing in the budget. But we think in those cases where it a relatively small number of cases, but for those people it'll make a difference, and for consistency across different types of study, and to make sure those people aren't left out. That's the purpose of the measure.
Of course. So those are the good news. I wanted it to I think the chair touched on this as well. In terms of the excise taxes, and I had a quote here from 1755 on what excess taxes were about, and I was going to repeat what it said, but I don't want to quote Samuel Johnson or the gentleman's name on excess taxes, because excess taxes are put in a place a time of production, not a time of sale, from my understanding, most times. And effectively, excess taxes, then you put the, say, in our country, you put the HST on it, so you're basically taxing a tax. Are there any other goods, I could say goods, that are subject to excess taxation in Canada? So we tax grape production, which is turned into wine, for example. Is there any other product that's grown subject to an excess tax?
So the list is relatively short. So you have alcohol products. I mentioned beer, spirits, and wine. You have, of course, all tobacco products that are subject to excise duties. That includes cigarettes, roll-your-own tobacco, tobacco sticks, cigars. The motive fuels are also subject to excise taxes under the Excise Tax Act. We're talking here about gasoline, about diesel fuel, aviation fuels, and there are also a couple of other products that may be subject to excise taxes, such as fuel-inefficient vehicles, the so-called green levy, and there is also a tax on AC units that are sold.
Effectively, the only agricultural product that's subject to an excise tax, in addition to, say, grape production, would be tobacco.
Grape production per se is not subject to an excise tax. This is the production of wine.
Yes.
And well, technically tobacco is somehow derived from an agricultural product as well, but these are historically,
yes,
for revenue-raising reasons and also for health-related reasons, these two big categories of products have been subject to excise taxation.
Do we know what so let me through this scenario. If you're investing in a beer manufacturing facility here in Canada, or wanting to invest abroad, and you look at excise taxes, was there any sort of relative comparison done between jurisdictions?
In a Canadian context where the bulk of monies collected by governments in respect of alcohol are from provincial governments, the latest numbers I saw is that they collect more than 4 times ours. From a purely excise policy standpoint, such analysis is just not needed, not with a 2% increase on our rate. There might be other studies done by the federal government, Agriculture Canada, I don't know. But
sure, because I'm looking at the cost of inputs into production rather than when you make the product then you sell it, which would be subject to a tax.
Maybe but just a point of clarification,
sure,
for instance,
please.
if a product is manufactured in Canada and then exported, no excise duties will be paid.
That's assuming 100% blend.
No, the other way around. So if a Canadian producer of beer or wine or spirits is probably the best example here. For instance, all the exports of Canadian rye that you have going to the States, there is an exemption from the payment of the excise duty for every domestic products and goods that are exported. Of course, on the other way, you may have an excise duty applicable in the importation of a foreign country, for instance, the United States.
Because I think on this policy measure, I think there's the consternation that I've heard is not about the absolute increase. It's about the automatic escalator clause that then kicks in year after year on the inflation component. And you can read through in terms of the policy and stuff and the bill. So that's what I've heard. I have a wine organization that's headquartered in my riding. They've expressed concern to me, so I'm bringing the concern of stakeholders. to it, so that there is some concern there because they will have to incur higher costs for their firm. So I do wish to put that on the table. And the fiscal impact from the beer measure, I think, was $20 million, and the other one, and the fiscal impact for the second measure on wine and spirits was 30 million. Or did I get those numbers wrong? Please help me on that one.
So if you look in the tax measure, the supplementary annex, we have a table on page 6, and it is shown that the alcohol taxation measure altogether is expected to generate $30 million in additional revenues for this very fiscal year. So this includes additional revenues from all three products stream.
And then you see the impact further downstream in 21-22 with the inflation component kicking in on the formula, going to a net impact of 160 million, correct?
That's correct.
Okay.
According to the projections based on future CPI in the future. Should there be, for instance, zero inflation in the future, you would not see an increase in the
Of course. I'm wondering if you run any, we call them algorithms, but any formulas on what coefficient that results in consumption of wine or alcohol, but we'll leave that for another day if I can find a study on that sometime in the future. I'm going to leave my questions there. I think I've used up my 5 to 7 minutes. Thank you.
We can come back to you if you have more anyway. What I'd suggest, I have left on my list Mr. Dussault, Mr. Greywalt, Mr. Leipert. I expect there'll be a few more. We'll take a 5-minute, you're off the list now, okay? We'll take a 5-minute break because we're going a 3-hour session here. We'll suspend for 5 minutes to give people a chance to stretch your legs. Okay? We'll suspend for till 10 after.
back in 5 minutes, okay?
Okay. Yep.
Just gotta go down.
All right, we'll come to order, and we're still doing questions on parts 1, 2, and 3 of Bill C-44. Could we have order over here, guys? And gals. Mr. Dussault, the floor is yours.
Merci, Monsieur le Président, et je suis content de pouvoir revenir.
Thank you, Mr. Chair. It's a pleasure to ask a few more questions. Let me go back then to part 1, the question I was asking earlier about insurers of farming and fishing property. Given that the government consulted BlackRock before creating the infrastructure bank, did you consult insurers of farming and fishing property before you proposed this new measure?
Thank you, Mr. Chair. I would say that the government is. I mean, there's a tradition of budget secrecy, of course, that relates to the preparation of budget measures, and that's considered to be most acute with respect to tax measures. The government obviously has to be concerned about speculation concerning potential tax measures, particularly those that would affect companies and financial markets and so on. So that means that there are limitations on the extent to which the department can kind of signal to stakeholders potential tax changes. But I would say that there were representations that have been made by the sector on their own sort of initiation, and so as a result, the government did hear from the insurance sector about this measure prior to the budget, and certainly took those representations into account.
Okay, sinon, sur un autre sujet, c'est...
So on another topic then, perhaps I can go back to the excise duties, perhaps for the last time, but something that was mentioned earlier. But one of the main concerns that I have heard about higher excise duties, and especially the sort of escalator effect, and also the World Trade Organization related exchange rates. I'm told that producers of French wine exporting into Canada, of course they make excellent wine, we all agree on that. So far we've tolerated the fact that 100% Canadian wines were excise tax exempt. They accepted that so far. But with this raise, higher taxes and the escalator effect, will this be tolerated by our economic partners, especially those in the wine sector, of course? So have you taken such a risk into account that our exemption on 100% Canadian-produced wine might lead to a situation at the World Trade Organization that, well, let's go to French wines again. French wines in Canada would, of course, be affected by the rising excise duties, but Canadians and their products will still be exempted. So, over time, their advantage will become greater and greater. So, did you foresee such a risk and protests at the World Trade Organization? Thank you for the question. Let me say that I'm not a specialist in international trade law. There's another branch of finance that does deal with that sort of issue in greater depth, and perhaps they could provide you with a written answer, an answer submitted to the committee, something more precise than I can provide. I wouldn't want to embarrass Canada and its economic policy by stating anything on a topic that I'm not the expert in. But one technical point I can share: the automatic escalator clause rising of the rates to manage inflation will remain, like the 2% in the current budget, of that nature. So why would that be less problematic than actually applying the interest rate rise in one area of commerce rather than another? So that's one issue. And then once again, if we look at this measure overall, the relative, really small size of this issue has clearly been weighed into the decision. 5 cents per 25 bottles of beer, 1 cent per bottle of wine, 7 cents for a 40% spirit, 750 milliliter bottle. So such measures, even if inflation were to continue to rise year after year, the measure is relatively small. It's a small one, a minor one. And we have to keep in mind the way provinces also raise taxes by imposing markups, and that's not necessarily even inflation related. Yes, I get that, especially the matter of this being only a few cents worth over what's already being applied as an excise duty. But here, my last question. I have it in English here. A reference to the fact, this is the Beer Association of Canada, fact that the excise duties haven't been raised since the mid-'80s, at least not much, and they say, that's what you said, but they say that they've actually risen by 44% in 2011 and 11.6% in 2006. So in 91, 44%, and in 2006, 11.6. So there we are, two changes to the amount of excise tax imposed. So would you like to change your statement? Well, what I stated, and I hope that this was gotten across in English, that there hasn't been really a large, important change. Of course, there was the GST and so on taxes in 2011 and the first drop in GST in 2006. So those are likely the causes of these adjustments to a number of duties and taxes. My understanding of the decisions made of the governments at the time was that overall the taxation on products was remaining equal. So one tax was being withdrawn, another was being applied. I don't think we need to get into all the technical details of that balancing, given that they are not at issue or being studied here in the current bill. But my understanding was that the actual rate hasn't changed since the mid-'80s, and I feel that that remains the case. The total rate, basically, despite certain statements that I don't have before me and that I haven't been able to study in depth. Thank you. That's a very apt clarification. Now, income credits for public transport, tax credits for public transport. Now, taking away that tax credit will generate $225 million a year in 2021 and 22, and $225 million. That's money that's going to be taken out of the pockets of people who take public transit. Let's make that clear. And 1.3 taxpayers have been using this tax credit. So that 1.3 million people and $225 million. We calculate $154 a person who has been using this tax credit. Now, you said this was not a very effective tax credit. Would you mind explaining how much would be needed to make it effective if 1.3 people, 225 million, isn't sufficient? Thank you for your question. Mr. Chair, as I had said, the measure aims to increase the use of public transport. So not only people who have claimed tax credits in the past use public transport, they're not the only ones to use public transit, and these figures haven't changed much over the years. So I referenced detailed studies, and what I can do is share our summary of these studies with the committee and with you, Chair, should you request it. Yes, that was my next question. Indeed, it's a question that was put earlier. You refer in your presentation to independent studies that seemingly show that the impact is quite limited. So, of course, the committee would love to see these studies to make a fully informed decision when we do vote on this matter. So, that said, let me address another topic, the taxis. You mentioned earlier that it's difficult to collect the taxes and relief on foreign businesses that are operating their business here in Canada, but are foreign businesses. So could you tell us a bit more about why this is difficult, specifically in the taxi business and ride-sharing operators? And so how is it difficult? Why is it difficult? In what way is it difficult to collect sales taxes on foreign businesses carrying out taxi business and ride-sharing business in Canada? All right, I won't address taxes. My colleagues may wish to say more about the tax part of that question. But as for the GST, the difficulty is that the company is not physically present here in Canada. The company is basically a website that people can access. I don't know where the website is hosted. The amendment, in English we speak of carrying on business in Canada.
C'est encore ambigu.
So that's still somewhat ambivalent. It's not too clear whether they're, if they're doing business via the internet, if they're actually doing business in Canada, if they're undertaking business operations within Canada. The difficulty is that even if we tell foreign companies, right, you're offering services via the internet to certain people, you're offering supply, and you therefore have to tax this supply, a goods and services tax. And if you don't, well, what can we use to enforce our request? We can't force the payment of Canadian taxes in foreign countries if these companies aren't present in Canada, don't have a foothold in Canada, but they're offering a service within Canada. Well, I don't want to say anything about that, really, because I don't really know. They're using the internet, which is available around the world. The servers may be anywhere. They may be hosted anywhere. And people are going through the internet to get a service. I mean, perhaps things have evolved since I ran into this problem. But the interpretation really is the business being in Canada that I'm giving you is for CRA, Canadian Revenue Agency, and it's based on the transactions actually occurring in Canada. All right, what I understand is that whether or not we enact this aspect of the bill, anyone who has registered their business incorporated outside of Canada, even if they're offering services in Canada, could, wheedle out, not pay taxes, a GST, on products and services consumed in Canada. So I'm afraid that we're heading down the wrong path here. Well, in the taxi business and ride-sharing business, there are operators offering services who are present in Canada. These are the independent drivers who are driving their own cars and offering ride-sharing. Now, they are present in Canada. We ask them to sign up, to register for GST, just the way we do ask taxi drivers to do so. And given that they have registered, they must charge the tax. So it's the drivers, then, who have to, yes, who have to register. Right, register and then remit the GST tax on a yearly basis. Not necessarily up to the company that's the umbrella organization via a website that takes care of that. Each driver has to do this themselves.
Taxi drivers who are independent have the same business model. So this did seem to create a problem when it came to the definition. We could talk about it longer because it's somewhat worrying to see that it's so easy to get out of doing what the government is asking. It's so easy for them to avoid paying GST. No, I think that's it. A question from Mr. Coulombe on excise duty. If, hypothetically, there was negative inflation in the short term, according to experts, it's not going to happen, but if there was negative inflation, would the escalator be negative as well? Thank you for that question. As I said earlier, the mechanism was based on the existing one for tobacco. There's no negative adjustment provided for, no negative adjustment possible. Only positive adjustments can be applied with the inflation mechanism proposed in the bill.
Mr. Leipert and then Mr. Deltel. I think that'll wrap it up. Mr. Leipert.
Yeah, I've just got a couple of brief questions. I wanted to follow up on the transit pass. And I'm glad to see you providing information to committee through Ms. Connell's question. But it would seem to me that, and I know that you mentioned that the tax credit was brought in for a carbon reason, but it would also seem to me that that this tax would be highly applicable to that lovable group that our Liberals like to call middle class and those working hard to join it. Now, you in the Finance Department would have, you wouldn't even have to really do a study on it. You could compile those who actually claim the tax credit versus how much they earn. So in a general sense, is it those who are working hard to join the middle class who mostly benefited from the transit tax credit? Is it those in the upper 1% that file taxes? That wouldn't need a study. That's information you should have. I'd like to know what your compilation of who actually claimed that credit, what percentage of tax filers sort of were in each category. And if you want to find it and get back to us, that's fine.
Yeah, well, we can follow up with exact numbers. I think what I can say now is that it's fairly evenly distributed across the population in terms as you know, when you just think of who takes public transit. That would seem reasonable. Well, there are quite a good number of individuals with low incomes who claim the credit but who didn't benefit because it was a non-refundable credit and they didn't have any tax liability to offset. So maybe I'll make those general points now and we'll provide specific numbers to the committee.
But those really wouldn't be applicable anyway because it's not a savings to government. That was a wash. So what I'd like to know is those who actually paid taxes, what categories did they fit into? Because I doubt it's in that upper 1% that we keep hearing about. I would suggest it's in that other lovable group that the government keeps talking about.
So we'll follow up with those
numbers. Thank you. Now, one other quick question, Mr. Chairman. This doesn't really apply to the bill, but we have a GST expert, I think, at the table, so I'd like to ask a question, see if you could respond to it. It has come to our attention that even though the federal government has claimed that there would be no revenue derived from the carbon tax, it would all go back to the provinces. It is now appears as though at least in two provinces, Alberta and British Columbia, where there is a carbon tax in effect, that the GST is applied to the carbon tax and therefore becomes revenue to the federal government. Can you confirm that for me?
The only thing I cannot talk about the commitment that you mentioned. What I can say is that at the inception of the GST, there was a policy decision made that the GST would apply to what is called a consideration to the supply, so it's the price being paid. And in terms of taxes, there would be only three exceptions: the general provincial sales taxes, the land transfer taxes, and tax imposed in lieu of provincial sales taxes, where the provincial sales tax don't apply. So that was the policy that was taking at the inception of the GST. So that's why there's many situations where there's tax, GST is being applied, even if a component of that price includes a provincial fee, a provincial markup, a provincial tax, a provincial levy, a provincial.
This should be fairly easy to answer, and I will not ask you to answer it today. But would you get back to this committee and clarify? And I'll give you an example. If a homeowner is receiving a heating bill, and the heating bill then has, in Alberta's case, there is no PST. So there is a carbon tax applied at the bottom of the heating bill, and then there's GST applied. Is it appropriate for me to ask you to report back to this committee whether or not that is in fact taking place, and if it is, what is the projected revenue for the federal government going forward on the GST on the carbon tax?
I cannot report on. We can report further on estimate of revenue if we have this, but right now the way the law is written is that the GST would apply on top of it.
Well, okay, but no, right. Is it, Mr. Chair? Can this committee ask?
We're here to deal with Bill C-44, but I mean, if there is an area that the department can provide further clarification on, I don't have a problem with that, because it could be either asked at this committee for further clarification or end up in an order paper question in question period. So if any of the witnesses think they want to take a stab at this, they're open to.
And I'm not even asking for the answer today. I'm asking if you could get back to this committee on that, please.
Then you can check it. Is there? You can check it out. Mr. Deltel, last questioner, I think.
Well, thank you, Chair. Thank you, Chair. Gentlemen, always a pleasure to talk to you again. A few minutes ago or an hour ago, we had the chance to talk about tax on alcohol. Now we'd like to talk about tax on tobacco. So I think that Mr. Coulombe will be my counterpart. Alors, ça va me faire plaisir de vous parler à nouveau. Merci à nouveau.
I'll be happy to speak with you again, and thank you very much for being so precise in the details you provided on taxes on alcohol. Now, moving on to tobacco. In 1981, we were the country that consumed the most tobacco per capita. It was a sad reputation to have. The campaigns since that time have made us one of the best countries, one of those who consume the least, who smoke the least per capita. Some people are finding that other issues are making people angry, but now moving on to what we're looking at today. Mr. Coulombe, have you assessed the repercussions that increasing excise tax will have on tobacco? Will it have an impact on tobacco as well? Will there be spin-offs of the escalator on other industries that are dependent? Alcohol doesn't cause the same damage to people's health than smoking does, and the repercussions on restaurants and places where people drink will have nothing to do with the repercussions that there would be where people smoke. In answer to your question, there are two details I'd like to give you to fill in the background on these measures. As my colleague explained for part one, we are withdrawing the old surtax on profit made by manufacturers of tobacco products in Canada, and an adjustment is made for the federal excise duty because the surtax did lead to revenue, and the adjustment is going to compensate for that somewhat. The adjustment is being made as of March 23rd, 2017. When we look at it in context, the federal government is going to get about $3.2 million a year through specific taxes on tobacco products. So an increase in government revenue with a new taxation system, yes. The adjustment, since we're going to take the revenue from the end of the chain, so that because companies that moved abroad were no longer subject to the surtax, so we wanted to put some balance back into the system. So there will be an increase of 55 million in the revenue from tobacco products. What you don't see in the table on page 2 is that tax measures already bring in, according to public accounts, under the Revenue Agency tab and CBSA tab. If you look at the figures there, they already bring in about 3.2 billion. Certainly they did for the fiscal year ending on March 31st, 2016. So 55 million in addition to the 3.2 billion. I don't think there will really be an impact on consumption. From the standpoint of tax policy, however, one of the government's objectives, as we see in the budget, is to ensure continuing taxation on tobacco products that supported the government's goal of reducing smoking. The tobacco tax is a two-edged sword. A good tax can stop people from buying a product, but too much tax and the smuggling trade grows. When I was a teenager, and I was born in '64, I'm from Quebec, Mr. Lévesque imposed very high taxes in Quebec on these products, and now I knew where I could get cigarettes then, just to fill in some background. When the surcharges came in the 2000s, in the 1990s rather, all it did was help the illegal cigarette industry to flourish. I had some excellent neighbors, some of whom started smuggling cigarettes and had to deal with the consequences. The trade in Wendake was ended, but did the Department of Finance calculate the critical point of balance where taxes are just high enough to stop people smoking and brings in revenue, and a tax that is so high that it simply encourages smuggling? Have you calculated where that balanced falls? Enough tax is a good tax, but too much tax is not a good tax. Generally speaking, the potential strategies to deal with future cigarette smuggling are always part of the equation when the government reassesses tax measures, as we're doing now. When we look at the efficiency and effectiveness of measures, We try to reduce excise duties where we can and keep things at a level where smuggling remains at a minimum. It's always difficult to hypothesize about where tipping points come. Canada is a huge country. The tax base for cigarette products is shared, for tobacco products is shared with the provinces. Each province has its own tax rate. Variation is huge between one market and another. One province may have a tipping point that's different from another province. The tipping point may be at a different place. Factors pertaining to smuggling may exist, but in one place but not in another. Our CMP colleagues and public safety can no doubt say much more on this. In recent years, we had seen some very individual problems arising with counterfeit products from China that looked so much like the legitimate products that had been made in Canada. There are illegal manufacturing issues in some parts of the country that might be quite a distance from import harbors. So there's a wide range of factors that prevent me from talking in too much detail about tipping points or hypothesizing about tipping points. However, with the measure that we see in this bill, which is designed to help us maintain the overall tax burden that tax policy has intended to implement, and given the very low impact that it's going to have on producers, I would doubt very much that this particular increase will have an impact on smuggling in Canada.
Merci. Merci.
Same thing was going through my mind. And illegal tobacco, you don't know what's in half of it either, which is a bigger health issue. You want it on again, Mr. Dussel?
Oui, assez rapidement, deux juste questions pour un suivi.
Very quickly, a brief question. Once again, Mr. Coulombe. And this is one of the concerns of the Canadian Cancer Society. All the excise duties that are collected on tobacco products, could they be directed towards awareness-raising campaigns to discourage consumers from smoking? Can you tell us what percentage of those excise duties? You said 3.2 billion or so. Are you able to give us an estimate of what percentage of that is spent on awareness raising and prevention measures by the federal government? Smoking prevention. Do you have those figures? And if you don't, could you provide them later? I don't have that information. What I can say is that there must be some way of checking. Health Canada may be in a better position to provide figures on what they spend in the area of prevention and awareness raising. We also need to take into account what provincial governments are spending, remembering, of course, that provincial governments do get some money from taxing tobacco products, and that adds up to much more than the 3.2 billion we're collecting. But there again, that's not our area of tax policy knowledge. What the Canadian Cancer Society is saying is that much more effort is put into prevention and awareness raising by the provinces, and they would like a greater contribution by the federal government, which does, after all, collect 3.2 billion. Back to public transit. You said, Mr. Leblanc, that public transit tax policy had not in 2006 achieved the public policy objectives established. the objective of increasing the use of public transit. So in your view, we haven't reached those public policy goals, but those goals still remain. They are also public policy objectives for this government, like reducing GHG emissions and to increase the use of public transit. Have you assessed any other options? It's all very well to take something away because you apparently it doesn't work, but do you have any options? Do you have a new tax credit or a new tax measure that you will establish to achieve those very laudable objectives and that remain the current government's objectives? Is there anything to replace that inefficient tax measure? Thank you for the question, Mr. Chairman. I can say that the government's decision is that tax credits are not the best way of supporting public transit. If we look at the 2007 budget, there was a great deal of investment in public transit infrastructure, over 20 billion over 11 years to the provinces and territories. So there will be significant spending, direct spending. That answers my question. Thank you.
Then that ends our questioning on parts 1, 2, and 3. Thank you all for coming before the committee and answering questions. We'll now turn to Mr. Haley and Ms. Bournes to look at Part 4, Division 1, Special Import Measures Act. Thank you, folks. And I believe there's a couple of things here to get back to the committee on, about 3.
I'll make some copies.
Of what? Okay, yes, we're going to do Part 4, Division 1, one by one, because they are significantly different. Okay, thank you. Then we have our witnesses at the table. First, we have Patrick Haley, who's the Director, International Trade Policy Division, International Trade and Finance Branch, and Laura Bournes, who is the Senior Economist, Trade Rules, International Trade and Finance Branch. The floor is yours for an opening statement, then we'll go to questions. And we're dealing with Part 4, Division 1, Amendments to the Special Import Measures Act. The floor is yours.
Merci, Monsieur le Président. La section...
Thank you, Mr. Chairman. Division 1 of Part 4 deals with amendments to the Special Import Measures Act, which is the primary legislation governing Canada's trade remedy system, under which duties can be imposed to address situations where dumped and subsidized imports cause injury to domestic producers. The Minister of Finance has legislative and political responsibility for the trade remedy system in Canada. Now, that system is jointly administered by the Canadian Border Services Agency and the Canadian International Trade Tribunal.
Section in Part 1. The first change relates to the implementation of a World Trade Organization dispute settlement decision, which found that Canada was in breach of its international trade rules. With these changes, Canada's trade remedy system will allow for the termination of an investigation, trade remedy investigation, where an individual exporter is found to have an insignificant amount of subsidy or an insignificant amount of dumping. The remaining 3 changes relate to proposals on which there were public consultations conducted at this time last year. 2 new proceedings will be created related to the enforcement of trade remedy measures. First, in Primer Link clauses 87 and 89, there will be new scope proceedings that will provide for binding and appealable rulings as to whether a good is subject to anti-dumping or countervailing duties. These proceedings will enhance transparency and predictability related to the enforcement of trade remedy measures in Canada. The second set of changes relate to new anti-circumvention investigations, and they are primarily in clauses 84 and 89. These new anti-circumvention investigations will provide for the extension of duties to goods from exporters who are modifying their trade patterns specifically to avoid the imposition of duties in Canada. So this will provide the Canada Border Services Agency with enhanced tools to address circumvention and a more effective enforcement. Third, the CBSA will also be given new powers to respond to situations where market distortions in the country of export make prices unreliable for the purpose of calculating dumping margins, for example, when there will be, for example, price controls by the government. So this will ensure that trade remedy duties are accurately reflecting market conditions in the country under investigation. And finally, one item that is not in Bill C-44 but was in Budget 2017 was the proposal that unions be provided with the right to participate in trade remedy investigations. This change is being implemented in a parallel process through regulatory amendments. So it is not in this bill, but it was announced in the budget. Overall, these changes will strengthen Canada's response to unfair trade, better align Canada with our major trading partners, and ensuring that we are abiding by international trade obligations. They provide important new tools for trade remedy investigators in Canada while maintaining the system's balance of interest between domestic producers and downstream users and consumers. Et ceci conclut la présentation de cette partie.
That concludes my comments on this part. We are, of course, very happy to answer your questions.
Do so. I don't believe there's any questions from this, the official opposition on this round. Mr. Dussault. Any over here?
Merci. Pouvez-vous clarifier, dans le fond?
Thank you. Could you please clarify the purpose of this? At present, there are companies that do engage in dumping, trade practices that can be called dumping under international trade law, and that's illegal. But if I understand correctly, by arranging their businesses in certain ways, they manage to circumvent the taxes and duties that we're trying to impose on them. One of the changes proposed regarding the anti-circumvention measures is to deal with practices by exporters that enables them to avoid anti-dumping legislation and countervailing duties when their products arrive in Canada. For example, does steel dumping come under that? What we're seeing in the steel industry from China, would this cover steel dumping, for example?
Trade remedy measures do apply to the steel industry. So I believe around 2/3 of all of our trade remedy measures relate to steel products, and the majority of those measures would relate to China. Many other Asian countries are also implicated, but China is the main target. And what we sometimes have seen and what other countries have encountered is that where a measure is imposed against China, there may be exporters in China that will try to either ship goods through other countries, ship unfinished goods to other countries and have them completed in that third country and then shipped onwards to another market. And anti-circumvention investigations would be used to then potentially extend that measure against China to the third country if it was found that the goods from China were still a substantial proportion of the goods that were ultimately shipped on to the domestic market. So there will be checks and balances to make sure that these measures are only extended where warranted, but essentially it will increase the enforcement of the existing measure by ensuring circumvention isn't happening.
Okay, merci.
Thank you. And Mr. Sabera, you have a question?
Thank you, Mr. Chair. In your opening statement, you used three words that caught my attention: modifying trade patterns. I believe that, and from speaking to some of the folks in the steel industry, you may have the occurrence of some countries exporting steel through third countries, and then having that steel production or that goods production. We don't have to use steel specifically, but that goods production then ending up on one of our ports. Would the remedies or would the legislation here deal with that sort of situation?
Absolutely. That would be one of the key situations that the anti-circumvention legislation is intended to address. There's two key types of circumvention. The first would be a modification to a product such that it falls outside the existing scope of a trade remedy measure. This could be such that a modification that doesn't change the essential characteristics of the product or how it's ultimately used, but it does change it enough that it falls outside the scope of the measure. For example, we've had situations where the chemical composition of a steel product was changed by the addition of a boron, of different chemical compounds. And we've also seen situations where a steel pipe, for example, will be, instead of 4-inch pipe, it will be made to be 4.1-inch pipe, such that it falls outside the scope of the measure. So these would be constitute a change to a product to fall outside the scope of a measure. The second type would be a change in origin. As I previously alluded, if a good that's subject to a trade remedy measure is shipped to a third country, if a good, sort of an input good or an unfinished good that is shipped to a third country and finished there, that may change the origin of the good such that it's no longer considered to originate in the subject country. So it would then be deemed to be coming from the third country, but ultimately the substantial proportion of the manufacturing of that good was still taking place in the subject country. And so in these instances as well, based on certain criteria, if we find that the substantial proportion of the production is taking place in the subject country, we'd still be able to consider that subject to the measure.
Sure, I'm done. Thank you.
Is there any other questions on this round? Basically, I think what you're saying is these changes give us a better opportunity to challenge those companies or those countries that are violating our trade law. That's basically the bottom line.
So circumvention practices aren't necessarily a violation of trade law in the sense that, making modifications to a product or to your trade patterns isn't necessarily a violation of any law. But if we can show that these practices are solely being undertaken for the purposes of avoiding duties, then we'll be able to extend the duties to those goods. So essentially, yes.
Thank you very much for that clarification. No further questions from members. Then thank you both for appearing before committee and answering questions. We will call up those on Division 2, Mr. Moreau, Mr. Wu, and Ms. David.
I only have two of the titles. I don't have Mr. Wu's title. I have Mr. Moreau. I put him in yellow.
Okay.
And Ms. David. And I don't have Mr. Wu's title.
Okay.
So he's not on there. So you can just give his title. I think he wasn't sure if he was going to make it.
All right. While the witnesses are are getting settled, just a note for committee. The Minister of Finance, he's got a very busy week next week, and we're trying to see if we could fit him in, and he has agreed to appear before committee at 12 o'clock on May 15th, so from 12 to 1 on May 15th, and we really appreciate the fact that the Minister is going to take the time to do that next week rather than on the 29th. So those that are working with the Minister can tell him we appreciate that very much. Then dealing with Part 4, Division 2 on public debt, we have Mr. Moreau, who's Director, Funds Management Division, Financial Sector Policy Branch, Ms. David, who's the Advisor Economist, Funds Management Division, Financial Sector Policy Branch, and Mr. Wu, I don't have your information here. I have your name, but not your position. So you can give that to us when you're speaking. You have a go ahead to explain Division 2, Part 4.
Thank you, Mr. Chair. We're to present and answer your question on Division 2 of Part 4, Clause 103 of Budget Implementation Act, which introduced the Borrowing Authority Act. This act authorized the Minister of Finance to borrow on the behalf of the Crown and provide for a maximum amount of borrowing. In Budget 2016, the government restored the parliamentary approval of government borrowing, which was last in effect prior to 2007. In Budget 2017, the government proposed to implement this framework by introducing legislation seeking parliamentary approval of government borrowing. Under the proposed Borrowing Act, Parliament is being asked to approve a borrowing limit. A requirement is also proposed for the government to return in front of Parliament at least every 3 years to report on the government aggregate borrowing relative to the limit and potentially propose a new limit if needed. Relative to the current framework, where the Governor in Council approves the flow of government debt only for the current fiscal year, the proposed Borrowing Authority Act enhances transparency to the Parliament by focusing on the stock of debt, so the overall level of debt of the government. The new Borrowing Authority Act also enhanced the accountability to Parliament by introducing the requirement that the reporting will be on the government debt, but also on the Crown borrowing debt. So basically, we're not only including the federal debt, we're also looking at the Crown borrowing corporation. The Crown Corporation borrowing, sorry. As presented in Clause 103, Section 4, you can see that the limit that is currently being asked for this year is $1,168 billion. Let me explain you how we get to this number. Basically, the first number we take into consideration is the stock of government debt. As of the end of the last fiscal year, year 2016, fiscal year 2016, the stock of the federal debt was $691 billion. To this number, we add the Asian Crown Corporation market debt. This number is $276 billion. To this stock of debt, we add the financial requirements set out in the budget 2017 for the next 3 fiscal years. This number is $103 billion. On top of this, we add the expected Crown borrowing over the next 3 years. This number represents $43 billion. To this number, we add a contingency margin equal to 5%. This 5% is taken from the highest level of the combined government and Crown Corporation debt over the next 3 years. The amount that we're adding is $56 billion for the next 3 years. Overall, this explains the $1,168 billion of borrowing approval that we have included under Section 4 of Clause 103. It should be noted that in terms of increasing borrowing requirement, we're talking here about an increase of $146 billion over the next 3 years. This concludes my summary remark.
Okay. Thank you. We will start with Mr. Deltel, then Mr. Severa, and then Mr. Dussault, and then Mr. Lippert.
Thank you, Chair. Madame, Messieurs, soyez les bienvenus à votre Chambre des communes.
Ladies and gentlemen, welcome to the House of Commons. Mr. Moreau. No problem if I speak to you in French? No, of course. That is what I thought. Very good. Now, of course, we have to take care when we use your name. Merely one letter in your name separates you from the minister himself. Now, Mr. Moreau, you added up a sum here, which may be surprising to many, but doesn't surprise us. We're over $1 trillion in debts, millions and millions when we add all the various parts of the debt. Now, what sort of pressure is this going to put on public financing such a debt, given that as of a number of years now, everyone keeps saying, oh, everything's going well, the currency exchange rates are good, but wow, they may go up. So what's the risk or danger that we would wind up with, $1 trillion debt? It's really un billion, we say in French, but, billions, trillions are confusing, so in French we adjust it. Anyway, we know what we're talking about, $1 trillion, and some the billions. So we're over $1 trillion at present. And a study carried out by the Minister of Finance tells us, and by the way, it came in on the 10th of October last, but was made public only a few hours before Christmas, that if nothing changes in 2050, the debt of Canada, and that's not even counting the Crown corporations, will be $1.3 trillion, $1.5 trillion, actually. So what about public finances in such a situation? Will there be any health? What's important here is the government's capacity to pay off its debt. So we are speaking of a debt of indeed over $1 trillion. The GDP, that's 50% of our GDP. Comparing Canada to the other countries of the G7 group, we're in a very favorable position. And we have one of the lowest public debts compared to these other countries. We're also in a very good position given our credit rating. We're the only country now in the G7 with a positive 3A credit rating. Good to remember. So yes, we do need to, hone in on our ability to pay and manage public deficits, but we have to take all these factors into consideration. Of course, the situation that you're telling us about here is that of the prior government, which allowed our country to actually get through the financial crisis and wind up with the best GDP, one of the best GDPs in the country, one of the best credit ratings in the world. So a good thing we were there to manage the country when the entire planet really was in a major crisis, the worst crisis since the 1920s. Now, that said, you've brought up something that's somewhat surprising. You said every 3 years you review the situation, the state of the situation. Okay. So why 3 years? Why not every 2 years? Well, it's somewhat arbitrary, that 3-year marker point. I do agree. But every year, for example, it would be pretty hard to come before Parliament to really reset the debt ceiling. Now, taking into account that we project 5 years ahead in the budget, we're really able to sort of foresee the next 5 years. So thus we decided on a 3-year marker to better understand debt management and the tax revenue situation. It's also more flexible for management purposes. If the government is in election period, for example, having a 12-month plan to bring in a new presentation of the potential debt ceiling is problematic. That's logical, but perhaps we should look at this a little more closely. When it comes to debt, this is a very high amount for public financing. I think we are now the this is now the debt servicing is the third largest cost managed by the Canadian government right now, so it might make sense to report on this every year rather than every 3 years. Now, you said that, of course, the budget is a 5-year budget. I've only been here for a year, so this is only the second budget I've been involved in. But in another government, I had noted that there is not a single forecast over the 5 years that actually comes true the next years. Year by year, we keep evaluating things, yes, but it never dovetails with the forecast of the prior year. So what's the use of forecasting 5 years ahead? Well, allow me to specify what I meant. I mentioned the 3-year period. It's up to the government at the helm to decide whether it might wish to hear from us every 1 year, but the maximum is 3 years. But if the government wishes to hear from us on a yearly basis, that is fully its right. And in the budget, we do have a debt management strategy, and we report to the government and thus to the public with figures. And we also report on debt management on a yearly basis. Now, back to economic forecasts. You know, it's not an easy domain, especially given the ups and downs of the market. We don't necessarily understand exactly what's going on around the world economically. A number of upsets to the system have complicated the very project that we have of forecasting. We know that we examine various sectors in the economy. We take averages. We ask people to contribute to risk analysis, higher or lower risk. So that's why we always have a contingency fund for the unforeseen. But this is not a problem that only Canada has. All the industrialized countries and all countries around the world have a problem. The World Trade Organization revises its forecasts every quarter. It's not a precise science, of course, and the ups and downs on the market are making things more difficult. Well, that's what my accountants say. Economists are always very good at explaining what has just happened, but predicting the future, but that's just folklore and hearsay. I won't go on in this vein.
Very quickly, the number on the borrowing limit, or the number that's there, that includes all the loan guarantees that are in place, correct?
I beg your pardon?
Includes any loan guarantees that are in place for debt issuances that were done?
No loan guarantees are included in this number.
Okay. And second of all, you mentioned about credit ratings and on the G7. Please correct me if I'm wrong, but I also understand Germany also has a AAA credit rating in addition to Canada's AAA credit rating. And depending on which agency you look at for the United States, they also still maintain a AAA credit rating with Moody's and Fitch, I believe, but not with S&P, if I'm correct.
You're totally correct. My statement was that Canada is the only country with a AAA rating from all the rating agencies.
I think Germany has a AAA.
Germany also, but I'm not done with my statement. I also said with positive interest rate along the curve, which is not the case in Germany right now because there's some section of the interest curve which are negative still in Germany.
Yes, and those are special.
So when you put, but you're totally right. Germany also has a AAA rating.
Yes, they do. Just wanted to make sure that we have that on the record. We don't want to have everything improper there. That's it, sir. Thank you.
Mr. Dussault.
Oui, merci. Merci pour votre...
Yes, thank you, and thank you for your presentation, and thanks for being here with us. So you've stated that, of course, you need the approval of Parliament, or maximum every 3 years, of the public debt ceiling and management, and you're telling us that this gives you more transparency. You can report and be more transparent. So could you explain what this 1 trillion, and I forget the remainder of it, it's over $1 trillion, but how does this make anything more clear to taxpayers? How is this transparency, just having this very large figure, given that Canadians can't see the details? Well, I think this adds to transparency thanks to the fact that these figures are now public. The facts are public, at least every 3 years or less. The current scheme we have which addresses only the marginal growth of debt year by year, is more difficult to understand rather than understanding the government's total borrowing needs over 3 years and making that clear and transparent. All right, of course, this may be a hypothetical scenario, but the Parliament will be enacting and voting on voted appropriations. Let's say that we carry the expense budget, but that 3 years down, the minister would be filing, it would be a bill that would allow for more voted authorities. It would be via the permission to borrow, and it would have to be a legislative measure. Yes, it would have to be a higher figure in the Act. Yes, so that's quite complex. No, getting through an Act. We deal with that on a daily basis in the House of Commons, and it's something that certainly takes time. And it depends on, the elected representatives and how they handle the vote, what they think of the Act. So basically, we have credits, supply provided for over any specific years, and if this voted authorities are higher than the ceiling that is permitted, is this something that you can foresee? Would that be a possibility, that there would be a discrepancy of that nature, that the Parliament pass voted authorities higher than what the Act actually allows for? Well, in that sort of situation, let's say the government had announced new expenses, new expenditures that would overshoot the ceiling, the limit, then they would have to ask for a different ceiling, a different limit in the budget and go through the whole process all over again. And that's why greater transparency about the system overall is helpful. If the government wants to spend more and the ceiling becomes problematic for them, then they will have to be transparent. They will have to go directly before the House of Commons to ask for the ceiling to be raised. But there we are. I asked whether the ceiling was a constraint. I have something in English here, but
provide the government with flexibility to meet unforeseen needs and standing authority to refinance outstanding market debt, subject to an annual approval by the government and council, so the cabinet. Donc, vous avez une flexibilité, mettons que...
All right, so you have some flexibility here, some elbow room. Let's say you have to raise it quickly for unforeseen reasons. You have an authority by the governor and council to raise it without consulting the government. Well, that might be an emergency. Let's say an unforeseen economic shock that would require the government to borrow unusually, then that's quite different than just raising the ceiling just because the government wants to spend more or provide more tax credits. It's like past crises which have forced the government to change its indebtedness levels. But if it's a program change, we would have to appear before Parliament to ask for a change to the limits imposed. Back to this hypothetical scenario. What if the Parliament refuses to raise the ceiling? Well, if the government refuses to raise the credit ceiling, then it's basically also rejecting the budget that's being proposed, because our credit limit is based on the government's funding needs in its budget. Do you understand that? No, I'm sorry, I didn't quite get that. If the government brings down a budget for the next 5 years such that the current ceiling is too low, then the ceiling would have to be raised. And if we can't do that, that's basically saying that the government won't be able to get its budget through, that budget through at least. So it would be the same thing as defeating the budget in the House of Commons, correct? And it would be a confidence issue, wouldn't it? Yes, an issue of the ceiling and whether it should be raised or not. All right. That's all, Mr. Chair. Thank you.
Mr. Leipert.
I just have a few brief questions that I need clarification on. 1.3 trillion was the number? Just for clarification.
The exact number is 1.1.
Yeah, so rough numbers. And what's the current debt?
The current stock of debt at federal level is 691 billion.
691, and the Crown?
And to that, you need to add the Crown.
Yeah, what is that?
Which is $276 billion.
And do you have a breakdown of what the Crown debts are?
I don't have it with me, but,
No, but
yes,
could you supply
we
it?
do. Yeah,
I wouldn't mind knowing
of
who,
course we
what
have
that is. And what is the interest rate that we would be borrowing this money at?
This year's, I don't have the number, but for 2016, our average rate on our borrowing program was 0.6%, so 60 basis point.
0.6.
0.6. And our overall interest rate of our total stock of debt at the federal level is around 2% right now.
I'm sorry?
It's around 2%, so 200 basis point. The overall cost of our debt, on average,
is 2% of our budget.
Oh no, not 2% of our budget. I'm talking about the interest rate cost.
Oh.
In terms of our budget, as a share of our budget spending.
Yeah.
This is a number I'll need to check, but it's not something I have with me.
Okay. And I think I just needed clarity on those numbers. I'm fine, Mr. Chair. I'm good.
Sorry, okay, you good? Sorry for the confusion here. We're doing two things at once. Is there any further questions to the Mr. Dussault?
Juste pour revenir sur les chiffres, on a dit 680.
To get back to the figures, 691 billion for the public debt. Then we add the Crown Corporation's debt, 276. Sorry, then we're missing some figures here. We're talking about pension responsibilities, or this is the debt carried by the Government of Canada and its Crown Corporations. That's not the same thing as the public debt. The public debt will be the debt plus the funding needs that the government has to cover pension plans and so on that aren't accounted or into the overall debt. So basically we're talking about the borrowing on for the debt overall, including its Crown Corporations. So 216, yes, what's missing from your figures are the funding needs for the next 3 years, including a public deficit and other needs to cover the debt to 146 billion a year. That's carrying the debt, and also 43 billion over Crown Corporations, and a reserve fund for 5%, and that is 56 billion. So then you get to the total 1,168 billion.
Wants on for one quick question.
Yeah, I just wanted to follow up on Mr. Sorbera mentioned loan guarantees. How do you factor that in as a liability?
Thank you, Mr. Chair. I'm the Chief of the Debt Management Section of the Department of Finance. So loan guarantees are, for accounting treatment, are not usually carried directly on the balance sheet. They're a contingent liability. So when we look at the issue of the borrowing limit, which is actually the way the approach we took was the actual borrowings that the government or the Crowns undertake in the markets or from financial institutions. So that's how this borrowing authority was scoped. In essence, it's very similar in scope with the existing borrowing authority approach or the pre-2007 approach that existed that also had parliamentary approval. We just focused, the focus is, or the scope is on the borrowing activities of the government. I think as my colleague Mr. Moreau indicated, the additional factor that we've added here is we've added Crowns.
Yes, I understand that, but I'm still not sure I understand, excuse me, how loan guarantees are accounted for. Are they a liability, or how would that work with government?
Yes, they're considered contingent liability, but I think as Mr. Moreau indicated, on the balance sheet of the government, there are lots of different types of liabilities. Excuse me, there are different types of liabilities, not just the market borrowings or borrowings from the financial institutions. For a borrowing authority, we scope it to basically reflect the borrowings from the market or from financial institutions, and those other liabilities are not factored in.
And one quick, I'm sorry, what is the current debt is 691. That's what we're borrowing. Okay. And what is our current, and as of the end of last fiscal year, what is our current debt payment annually?
I don't have that number offhand, but that's something I could verify for you. Sorry.
Us on that. So, just so I'm clear on this loan business as well. So, does you mentioned in your earlier statement, I think, contingent liabilities. Does that cover off the loan?
No. So I'll give you some examples of other type of liabilities, like pensions.
Okay.
Pension liabilities. There are other payables that the government may be liable for at the end of a fiscal year. So these are factored into the total liabilities. And to just give you a comparison example, this balance sheet concept of total liabilities actually amounts to $1,088 billion. But it is a different concept. It's a balance sheet concept. So guarantees, these other liabilities are captured under this different concept.
Okay. Mr. Leipert, go ahead.
What was that figure again?
It's $1,088 billion. Pardon me.
So our contingent liabilities exceed or double, or if you added the contingent liabilities to the borrowing, it would double, more than double.
Thank you for that question. I would actually express it in two different ways. So the one concept is the balance sheet concept, and this is where the question of liabilities, other liabilities come in, like contingent liabilities. That measures sort of an accounting concept. The concept we tried to capture here in the borrowing authority is basically market borrowings.
And I understand that. It's not the same thing. I understand that. Would the Bombardier loan be in that is that the kind of thing that would be in the 1.88?
Sorry, the $1,160 billion, the borrowing authority?
No, not in the borrowing.
Oh,
in the contingent liabilities.
Oh, I see. So I would have to double check with our accountants because some of them are carried on explicitly in the balance sheet. Others are in another category, which are not reflected in the $1,088 billion.
I'm just
so
trying to get a sense of what that is. I understand it's not a debt.
Okay. I think that's it. Thank you, folks, for appearing and those explanations. We are at 6:30 because tomorrow there's votes. We're only going to be able to meet 2 hours. So we are going to have to try and move. I'm worried about some of the people who end up coming here, sitting and waiting, and then we don't get them on. So we're going to have to get back to some of the people responsible for some of these divisions and give you a heads up, because we're not going to get through them all tomorrow in 2 hours for sure. I think we've decided that Division 7, we will leave them till Thursday, because we're going to hear from the parliamentary budget officers on Wednesday. So does anybody, I guess I think people are ready to call it a day, are they? All right, we will adjourn. Thank you again, folks, for your presentations, and we will adjourn until tomorrow.
you.